We are back looking at insurance news. Sounds so exciting, but this stuff is important. It's a high-level overview of what's going on in financial markets, and it seems like reinsurance carriers and governments alike are getting more and more nervous about the risk. So let's dive into some articles here. I'm going to look at an article that reviews what the government is looking to do as far as reinsurance, and I'll explain more about that. Also looking at some company earnings. Progressive just came out with some earnings, and I want to decipher that for you into layman's terms. So stick around. We'll get a pulse of what's going on and stay as neutral as possible in regards to politics. So let's get into it. So the first article here is from The Hill, and it is an opinion piece, but there's some interesting information in this one, and it's no surprise that the government is trying to get into the insurance business. Particularly since Katrina, we've seen the government propose taking over the reinsurance market and taking on that risk. They're convinced that they can do a better job than these large companies that have been doing reinsurance for years. And so we'll read through some of the facts and decipher the difference between the opinion and fact. And of course, no one has a crystal ball, but I will let you know that my bias is that the private market is more efficient than government. Government tends to add departments and bureaucracy to everything they do, and at the end of it, maybe one person could do a job that 10 people are doing. They never fire anyone. There's no reviews as far as productivity, or there's no outcome-based accountability usually in these governmental departments. They just continue to exist like a blob and grow and grow and grow. And half the time, the citizens that are paying the taxes to support these agencies have no idea of actually what's going on within the company. So the fact that they want to manage this much money is pretty frightening. In my opinion. Again, here's an opinion. Again, not trying to be political here. It's just really looking at facts. So opinion, another government-run insurance scheme is the last thing the nation needs. That's this article. Reinsurance is insurance for insurance companies. So reinsurance is the insurance that insurance companies use for catastrophic claims. So think of the difference of a high deductible health plan for you as an individual versus a health plan that covers you at 100%. A plan that covers you at $6,000 deductible is going to give you more risk, right? You're going to have to self-fund the first $6,000 of any health insurance claims that you have in that scenario. And that is similar to reinsurance. Reinsurance is like a very large deductible for these insurance companies. So for instance, let's say they have a reinsurance policy with $1 million deductible per insured or per policy. And once they have, so that means once a policy claim goes over $1 million, then these reinsurance carriers come in and cover the rest. Or they may have an aggregate plan and all of that insurance nerdy stuff. Promise I'm not going to get into the weeds on that. But just as a basic concept, that is reinsurance. If insurance is the financial first responder to disasters and events, reinsurance companies are the shock absorber, the backbone, enabling insurers to have more stable, predictable returns by spreading the brunt of catastrophic loss to dozens of payers in the global market. The Insure Act, introduced by Representative Adam Schiff of California in January, aims to add additional capacity to the reinsurance markets with the creation of a federal insurance entity with startup capital of just $50 billion from the U.S. Treasury balance sheet. The facility would cover flood risk and eventually also cover windstorm, hurricanes, severe storms, wildfire, earthquakes, and so on. This would shut down the National Flood Insurance Program. So it would basically be a takeover program. I do like that component. The more of the federal programs we can shut down, if we can redo them all and figure out a better way, I'm totally open to that. I'm just suspect that, and this act has other components to it that will not be beneficial for the markets, the insurance market, the financial markets, and so on, just because of the track record of the government. The proposed Insured Act bears the fingerprints of self-styled consumer crusaders who have demonstrated for decades. Consumer watchdog founder Harvey Rosenfield gives insurers an eye poke. It is increasingly clear that the insurance industry is unwilling or unable to serve the needs of its consumers, and for that reason, government intervention is necessary. If he is going to make a statement like this, he needs to really back it up with an example. There's so much regulation in insurance. Every comment that I see in here is stating basically that insurance companies are not held responsible. They 100% are. There's tons of regulations in the industry. An insurance company can't just create a policy and tell you they're going to pay out and not pay out. They pay out every single time. So I don't know where this is coming from. I think that insurance companies have had bad PR in the past. I think they're an easy scapegoat for people. It's this big black box that people see as something that is easy to point the finger at, and not really seeing that they are paying claims. Yes, they are managing large amounts of money, and this article will go on and talk about how it's a feast or famine industry, especially in the reinsurance industry. And I'm not saying there isn't any funny business going on and zero corruption. Any large organization tends to have lots of bureaucracy. The larger a company gets, the more bureaucracy there is. There's more political mumbo jumbo that goes on. There's more potential for funny business between regulators and large companies. The larger the company gets because of because of multiple reasons. So no one's saying the insurance markets are perfect. I'm not certainly saying that. However, I think just randomly saying that, these people are an eye poke, or these companies stating that it's increasingly clear that the insurance industry is unwilling or unable to serve the needs of its customers, I think is a very strange statement, especially if there's no evidence or no examples to back it up. The proposed management structure of the facility is frightening, and this is the comment of the person writing the article. Its advisory committee includes 5 consumer advocates, 3 insurance and 2 reinsurance company representatives, 9 representatives from government agencies, 8 assorted others. So on a 27-person advisory committee, only 2 would bring reinsurance expertise to the party. Again, just sounds like more bureaucracy and red tape and a reach for control over private markets. Reinsurers do much more than collect premiums for putting their capital at risk. Reinsurance is unlimited risk. They are taking on, think about Katrina. No one had any idea that that disaster was going to happen. It was billions of dollars. The people were left, if my memory serves me correctly, the government wasn't there right away. There were all sorts of failures on a government level in responding to that disaster. And now the government wants to come in and say, oh, we want to take this over. And by the way, these insurance companies that have been handling this for decades and taking on this limited risk, unlimited risk. They have no idea how much the next huge disaster is going to cost. You're taking on this unlimited risk, and oh, by the way, you're not doing it right and you're not serving your people. So we're going to look at here in a moment some earnings report that came out for Progressive just today and talk about what is the profitability of these insurance companies. Are they just raking it in and not paying out claims and just arbitrarily raising rates? No. Insurance tends to be a lagging, increasing, inflationary market. They tend to be I guess a better way of saying it is the insurance companies tend to be kind of the last ones, or one of the last ones, to show how much inflation is going up. So everyone experienced inflation really first probably with not being able to get supplies to build their houses, right? And so housing prices went up because it was harder and harder to build a pool, or remodel your kitchen, or find a refrigerator or a dishwasher. So dishwashers and refrigerators, instead of maybe being $1,000, they went up to like $3,000 because of supply chain issues during COVID. Then we saw it hit the grocery stores, and our grocery store bills have gone up by 50 to 100% in just since 2020, probably. So people certainly see that there, and I think that most people understand that grocery stores are not making a huge profit margin. It's like a 3% margin business, or 2%, or probably 1% in some cases. Not a huge margin there. Nobody's starting a grocery store and making 20+% in that way. Same goes for insurance companies. I mean, the profitability is not giant. Again, we'll go over that here in a moment. And when parts for your cars, so if you're getting car insurance and a car insurance part has gone up by 100%, yes, your insurance premiums are going to go up, because when the insurance company has to replace that bumper or replace that car, it's going to cost them more money, which then makes the premiums go up. They're not just going to absorb it and say, oh, don't worry about it, we'll take it, we'll operate this business at a loss because we understand that it's tough out there and we're big and you're small. No, they're going to look at the numbers, they're going to see that their profit margins are shrinking rapidly, and increase the premium. I'll go on with the article. Other red flags in the proposed design of the program include price controls, limiting premium growth exceeding 7%. This would usher in inevitable subsidies to provide cover at below market rates, insulating consumers from rate increases, dulling incentives to pursue sound risk management. Yes, risk comes and goes. I mean, we have Katrinas, we have these disasters that, God forbid, they don't happen every year. It's probably once every 10 years, or, now we're looking at going on 20 years, I believe now, since something like Katrina. So these insurance companies, they build up reserves for these kinds of catastrophic events. And if you put caps on how much they can put in reserves or how much they can increase premiums, it's going to drive insurance companies out of the market. And when you drive insurance companies out of the market, you incentivize monopolies and you leave it where there's no competitors. And of course, the government has to step in at some point. Eventually, they're choking out the market so that there are no competitors, so that they become the monopoly of the industry and control the industry. The article goes on, the bill's attempt to provide stable catastrophic reinsurance markets fails to understand that property catastrophic reinsurance is by its nature volatile feast or famine business. Just like I was saying, for example, in 2005, the year Hurricane Katrina, Rita, and Wilma hit, reinsurers licked their wounds, paid their losses, and lightened somewhat with reinsurance for reinsurers known as retrocessional reinsurance. The catastrophic load in 2006 and 2007 was light, strengthening reinsurers' balance sheets and income statements until the next catastrophic heavy year, which was 2008. So yes, they took a loss, many of them in 2005, 2006, as they paid out claims. And then 2007 was a pretty good year where they were able to catch up and cover the next heavy risk year, which was 2008. The private reinsurance market works. Property catastrophic reinsurance rates declined at the Florida-focused June 1st treaty renewals. New capacity entered the markets in the form of record investments in insurance-linked securities. Even Florida is attracting capital from new companies. These are signs of a healthy market. Insurers use the global reinsurance industry to spread the risk to all these reinsurers. Reinsurers, in turn, limit the risk they take on by only taking a slice of each insurer's risk. The result is that insurers may have dozens of reinsurers on their reinsurance panel. For example, the medium-sized Pennsylvania National Mutual lists 55 reinsurers in its statutory filing. Larger insurers have many more, with each reinsurer taking on only a sliver. So with risk, spreading out the risk to multiple insurance companies can or does help make sure that not just one company is taking on this unlimited risk and driving that company out of business, and there are backups on backups. Government-run insurance programs like the federal crop and federal flood insurance have generated gaping deficits. Crop insurance is so heavily subsidized that farmers only pay 1/3 of actuarial appropriate premiums for a program allowed to run at a combined ratio of well over 200%, notwithstanding misleading crop insurance accounting. Crop insurance has generated $37 billion in cumulative historical deficits. Flood insurance has finally on the road to reform with a recent introduction of Risk Rating 2.0, which seeks to phase in risk-adjusted rates and eliminate subsidies. It is ironic that the Insurance Act, or the Insure Act, would gut the NFIP for soon after it started to recover. So they're saying that it's interesting that now that this program, this federal program is recovering, now they are looking, this flood insurance program that is federal and owned by the federal government is just starting to recover, and now they're going to gut it. Instead of contemplating a government entity that would disrupt reinsurance markets, add to our national debt, and burden consumers, Congress should pursue more dynamic strategies like encouraging nature-based solutions that have proven to mitigate costs of recovery while protecting existing natural systems. No subsidized, unprofessionally managed government program disguised as a reinsurance facility would replicate the value of a reinsurer, whereas consumer advocate Rosenfield maintains government intervention is necessary. The history of government-run insurance is riddled with failures. I completely agree. Create a government reinsurer overseen by consumer activists and government agency representatives. What could possibly go wrong? Yes, there are many examples of when these large organizations and large government entities intermingle, it turns into fascist-like control over markets and tends to drive away competition and increase pricing or decrease efficiency, and inefficiency is going to just drive premiums up and create monopolies and eventually create a government monopoly. Progressive Insurance reports latest monthly results. So let's look at some of these profitability questions that come up because people see these numbers, 6.5 billion, 5.9 billion, and they assume that that's what the insurance companies make, right? I mean, they're just making billions of dollars, yes, but we need to look at the percentages. So many businesses make, 5%, 3%, 10% in these large financial markets. So the more a company brings in, if you're bringing in billions of dollars, it's likely that your profitability is a single digit percentage. Now, small businesses usually want to see at least a 20% profit margin for cash flow and for growth and marketing, and again, to grow and go up market. And these tech industries, their profitability is way higher. You'll see 50% is not uncommon in the tech industry or software, things like that, because there's not a lot of manpower required once a software or tech company is built. It's usually that the software is running. Obviously, that's the point of having a software, because it creates more efficiency and not as much maintenance on a salary basis. You don't need as many employees perhaps to run the software company as you did to build it, right? So maybe a startup in tech is running at a loss for a while. Once they build the software, then it can run at 50% profit margin. Well, insurance and financial markets, they build and build and build and build, and they have so much risk that they need to manage, and so much capital that they need to have in reserves. Reserves means it's money that they don't touch, and their margins tend to run very slim, and this is an example of what is going on in the insurance market right now. So this is for Progressive, and it says, and this article is by Insurance Business, insurancebusinessmagazine.com. According to the insurer, its net income in August was $935.3 million. The company's net premiums written and net premiums earned were $6.5 billion and $5.97 billion, respectively. The latest combined ratio, meanwhile, was 85.5%, an improvement from 97.2%. Okay, so 97.2%. Of course they had to increase their rates. If something happens, they would go out of business if they didn't. So 97.2%. That means that they are paying, for every dollar they were collecting, they were paying out 97 cents, less than 2, so they have 3 cents. So for every dollar that they collect, they were paying out almost 97 cents, keeping less than 3 cents for profits. Okay, less than 3% of a cushion. So of course they had to increase their rates, and now they're running better at the 85.5%, so just under 15% margin there, which is a lot more comfortable for them looking forward. And of course, in order to reach that number, they had to increase rates. Additionally, Progressive's policies in force grew across all segments: personal lines, commercial lines, and property business. So these insurance companies have to price their insurance high enough so that they can cover, obviously, their claims, but also remain competitive in the market, because they have other competitors. They have Geico, they have Allstate, and if they just arbitrarily increase, let's say they want to get to 80% combined ratio and run at a 20% margin, that may not work for them, because they may end up being more expensive than a Geico or an Allstate and lose business to those other insurance companies. So that's where competition in the market allows the insurance companies just to be honest and really fight and make their pricing competitive with other competitors. Additionally, Progressive policies in force grew across all segments: personal lines, commercial lines, and property business. Total policies in force amounted to 33.4 million. In August, the firm introduced "We Exist to Help People Move Forward and Live Fully" is their new purpose statement. The brand posed seeking to amplify the insurer's commitments while continuing to champion existing initiatives spanning progress on the road, in home, and in business. Many people may not know this, but Progressive's founding strategy was to help create access to insurance for an underserved market of people, says the Chief Marketing Officer, Remy Kent. Protecting and providing access is in our DNA. Progressive, which would like to be known as the first purpose-driven insurance company, is collaborating with organizations and experts across both the public and private sectors to help advance its goals while also supporting its more than 60,000 employees. So again, just driving home that competition is important, even in insurance. And if we have a government program come in and just completely railroad and take over the reinsurance market, create more inefficiencies in the market, reduce competition, it is going to drive up costs. You know, if the reinsurance market increases, companies like Progressive will have to pay more for their insurance or for their reinsurance, and you as a consumer will have to pay more. So with that, I'm going to wrap it up. We're going to continue to keep an eye on insurance news. We're expecting more increases in the last quarter of 2024 and going into the first quarter of 2025 and beyond. To stay up to date, please like and subscribe. If you want an assessment from me for your business insurance, if you're a CEO, CFO, decision maker within your business, please reach out to me. I have a link down below. Looking forward to talking to you, and see you next time.